Welcome, everyone, and thank you for joining us. Since many of us associate taxes with one date on the calendar, April 15th, we thought this would be a good time to take a step back and look at taxes differently, not just as a once-a-year filing exercise, but as an ongoing part of your financial life.
Exactly. Filing your return is about reporting what has already happened. A tax strategy is about looking forward and making choices that can change your future tax picture. The goal is not just, how do I get a bigger refund this year? It is, how do I avoid paying more than the law requires over my lifetime?
So today we'll walk through what it really means to move from tax preparation to tax strategy, how to coordinate with your financial and tax professionals throughout the year, and some specific levers you can pull, things like income timing, retirement plan contributions, charitable giving, Roth decisions, and estate and gift planning.
We will keep this conversational. We both work with clients on these issues every day, so think of this as a guided discussion on the ideas that matter most. And of course, everything we share is for general education only. It is not specific tax or legal advice. Before you act on anything we discussed, you should talk to your own tax, legal, and financial professionals.
Let us start with a basic question. When you think about taxes, you probably think of getting documents in the mail, sending them to your preparer, and filing your return. That is classic tax preparation. It's necessary, but is by definition backward looking.
Right. At that point, we are working with history. We can make sure the return is accurate and we can take the deductions that are available, but most of the big decisions have already been made. Your income has already been earned. Your investment gains and losses have already happened. And your giving and retirement contributions are in the books.
A tax strategy is different. Think of it as an ongoing approach that connects your past, present, and future. You're looking at your income, how your assets are invested, where you have unrealized gains or losses, how much you're saving in pre-tax and after-tax accounts, and what you want to do for your family and charity, all through a tax lens.
And it is multi-year. Sometimes a good strategy means you do pay more in taxes this year so that you can pay less over the next 10 or 20 years. Roth conversions are the classic example. You're choosing to recognize income now in order to enjoy tax-free withdrawals later, or to provide more flexible assets for your heirs.
So if you're listening and wondering, why should I care about tax strategy? The short answer is that your tax return records what has happened. Your tax strategy shapes what happens next. That is why we want to have this conversation now, while there's still time to plan for 2026 and beyond, rather than only reacting next spring.
And that is also why coordination matters. Your financial advisor and your tax professional see different parts of your picture. When we work together during the year, instead of just trading documents at filing time, we can often find opportunities that would otherwise be easy to miss.
Let us lay out the main building blocks. When we talk about your year-round strategy, we're usually working across a few key areas: income timing, how and where your money is invested from a tax perspective, charitable giving, Roth contributions and conversions, tax loss harvesting, and then estate and gift taxes for larger estates.
I like to think of it as a menu. Not every tactic will apply to every person, and we are not trying to pull every lever every year. The value comes in from looking at your situation in an organized way and deciding which levers make sense now and which are better saved for later.
And this is where having a simple tax calendar can help. Instead of thinking about taxes for a few frantic weeks in March and April, we will talk later about what you might want to look at in the first quarter, middle of the year, and toward year end, so these things become part of your regular planning rhythm.
Before we get to timing, maybe we start with how income timing actually works in practice, because that is one of the first areas where coordinated strategy can have a real impact. Income timing is simply about when income shows up on your tax return and when deductions show up. You cannot move everything. Your salary is typically fixed, but there are areas where you do have some flexibility.
Examples that come up often in my work are timing a bonus, deciding which year to take the discretionary distribution from a retirement account, or when to recognize income from things like U.S. Treasury bills or self-employment work.
The classic move is to defer income into a future year and pull deductions into the current year so you lower this year's tax bill. But that is not always the right answer. If you know you will be in a higher tax bracket next year for some reason, it may actually make sense to accelerate some income into this year and pay at a lower rate.
This is where projections matter. If we can sit down together, look at your expected income for this year and next, model different scenarios, and then coordinate with your CPA, sometimes we can keep you in a lower tax bracket over several years rather than bouncing you up into a higher one unexpectedly.
And I would add, these are not decisions to make in a vacuum. The same move that looks good from a tax standpoint might not be ideal for your cash flow or your retirement plan. The point is not to chase every possible tax savings. It is to make coordinated decisions that fit your broader goals.
Another core pillar is how you use tax-advantaged accounts. Traditional retirement plans are still one of the most effective tools we have for managing taxable income.
Absolutely. A traditional 401k or similar plan lets you defer part of your pay, which reduces your taxable income in the year you contribute. The money then grows without current taxation, and you pay income tax later when you withdraw it in retirement.
For 2026, you can defer up to $24,500 into a 401k. If you're age 50 or older, you can contribute an additional $8,000 as a catch-up. These limits move periodically, so this is a good example of something we want to review each year as part of your strategy.
And recent Secure 2.0 rules added a few twists. One that surprises people is that if you are 50 or older and earn more than $150,000 in the previous year, your catch-up contributions must be a Roth, meaning that they are after tax even if your base contributions are pre-tax.
There's also the so-called super catch-up for people who are 60 to 63 during the year. This year, those participants can contribute an extra $11,250 to certain plans like a 401k, 403b, and governmental 457b plans. That can create a powerful opportunity if you're in your final working years and want to accelerate retirement savings.
The takeaway here is that the contribution limits and rules are not static. Part of a good tax strategy is simply staying current and making sure your savings pattern is aligned with the latest rules rather than the last year's assumptions.
And the more you coordinate those decisions with your long-term plan, the more strategic you can be. For example, deciding whether it makes sense for you to prioritize pre-tax contributions, Roth contributions, or some mix of the two. Let us talk about charitable giving. For many clients, giving is value-driven first, but with the right structure, it can also help manage taxes.
The One Big Beautiful Bill brought a number of charitable rule changes starting in 2026. One of the headline items is a new above-the-line charitable deduction for people who do not itemize. Single filers can potentially deduct $1,000 of cash gifts to public charities, and married couples can deduct $2,000 subject to the rules, even if they don't use the standard deduction.
There's also a new floor for itemizers. Only the portion of your charitable giving that exceeds 0.5% of your adjusted gross income will be deductible. And for very high earners, the value of itemized deductions, including charitable gifts, is capped at 35% benefit.
Qualified charitable distributions are another important tool. If you are at least 70 and a half, you can give directly from an IRA to a qualified charity. That donation can satisfy all or part of your required minimum distribution, and it does not show up as a taxable income. For 2026, the QCD limit rises to $111,000.
For high net worth households, donor advised funds can be a very effective structure. You give cash or appreciated securities to the fund. You get a deduction in that year if you qualify, and then you can grant money out to charities over time. It separates the timing of the tax deduction from the timing of the gifts.
The flexibility becomes especially valuable in years when your income spikes. You might choose to bunch several years of giving into one tax year in order to itemize and get more value from your deductions. Then use the donor advised fund to support charities steadily in the following years.
And again, the key is planning. If we know your giving goals and your income picture, we can work with your CPA to determine whether strategies like QCDs, bundling, or a donor advised fund make sense, and if so, when.
Let us move to Roth accounts because they are central to any discussion about paying tax now versus later. With a Roth IRA, you can contribute after-tax dollars, and if certain rules are met, your earnings and withdrawals can be tax-free.
One of the bigger strategic questions we discuss with clients is whether Roth conversion makes sense. That means moving money from a pre-tax retirement account into a Roth IRA. You pay tax on the amount converted in that year, but future qualified withdrawals are not taxed.
The trap is that a full conversion in 1 year can push you into a much higher tax bracket. That is why many people look at partial conversions over several years, often targeting lower income years or years before required minimum distributions begin.
This is also an area where the 5-year rule matters. To get tax-free earnings, you need to satisfy the 5-year holding requirement and be at least 59.5 or meet another qualifying condition. So conversions need to be timed with your expected retirement income needs.
When we build a tax strategy with clients, Roth decisions sit alongside everything else. We look at your projected tax brackets, your sources of income, your charitable plans, and the legacy you want to leave. The goal is to not simply to own Roth accounts, it is to use them in a way that supports your broader plan.
Another tool that gets a lot of attention, especially in volatile markets, is tax loss harvesting. In simple terms, that's selling an investment at a loss to offset capital gains elsewhere.
Right. Losses you realize can offset gains on other investments. If your losses exceed your gains, you can usually offset up to a limited amount of ordinary income each year and carry the rest forward. It can be a useful way to soften the tax impact of rebalancing or of concentrated stock positions.
Two important nuances. First, long-term losses must be used against long-term gains before you apply them to short-term gains and vice versa. Secondly, the wash sale rule prevents you from claiming a loss if you buy the same or a substantial identical security within 30 days before or after the sale.
And from my perspective, the caution is that the tax tail should not wag the investment dog. We never want to sell a holding that is still a strong fit for your long-term strategy just to create a loss. This is a tool that works best when your investment and tax plan are coordinated.
For families with a significant wealth, estate and gift taxes are another important piece of the tax strategy conversation. The OBBBA gave us more clarity here.
The law sets the federal estate and gift tax exemption at $15 million per person, or $30 million for married couple, indexed for inflation. That is a very high number, which means more than 99% of estates will not face a federal estate tax under current law.
But for clients whose estates are over that threshold, the tax rate's 40% on the excess. And separate from federal rules, some states still have their own estate or inheritance taxes at much lower levels.
That is where techniques like lifetime giving, spousal trust, and other structures come in. You can move assets out of your taxable estate, often while still providing for a spouse or future generations. But it has to be done carefully and in coordination with your estate attorney and advisor.
Even if your estate is below the federal threshold, the same mindset applies. The earlier you start talking about what you want to happen with your assets, the more options you have to align your tax picture, your legacy, and family dynamics.
Let us talk about surprises, because many of the unpleasant tax experiences we see are avoidable with a little planning.
Quarterly estimated taxes are a big one. If you have income that does not have withholding, like self-employment income or certain investment income, you may need to make quarterly payments. If you do not, you can face penalties even if you pay your full bill by April.
The IRS has safe harbor rules that can help you avoid underpayment penalties. For example, paying at least 90% of your current tax year or 100% of the prior year, subject to income levels. But you have to know where you stand during that year, not after the fact.
Another surprise we see is around withdrawals from tax-deferred retirement plans. People are sometimes caught off guard when they realize that every dollar they take from a traditional IRA or 401k is taxed as ordinary income, and that required minimum distributions can push their income and therefore their tax bracket higher.
That is where a coordinated retirement income strategy is critical. We can plan the sequence of withdrawals from traditional accounts, Roth accounts, taxable investment accounts, and coordinate that with Social Security timing and charitable moves, so you understand in advance what your tax picture will look like.
To keep all this manageable, we often suggest a simple tax calendar. For example, in February and March, focus on filing returns or extensions, making final IRA contributions, reviewing last year's tax returns, and paying first quarter estimates. In April through June, review your income and withholding, make second quarter payments, and look at early tax loss harvesting opportunities if markets have moved. In July through September, revisit your charitable plan, evaluate the pros and cons of Roth conversions for this year, and make third quarter payments. From October through December, finish any tax loss harvesting you and your advisor thinks makes sense. Maximize retirement contributions, including catch-ups if appropriate. Consider bundling charitable gifts and decide on the timing of any bonuses or other discretionary income.
When you spread the work out that way, taxes become part of an ongoing planning cycle instead of a once-a-year scramble. It is the same set of decisions, but made with more time and less stress.
To pull this all together, tax preparation is about accuracy and compliance. It records what has already happened. Tax strategy is about shaping what comes next over many years, not just one.
And the most effective strategies are rarely about a single technique on its own. They come from coordinating everything we discussed today: income timing, tax advantage saving, charitable planning, Roth decisions, investment moves, and estate and gift strategies, and doing that in a way that supports your goals.
If today's discussion raised questions for you, a good next step is to sit down with your financial advisor and tax professional and ask, what does my strategy actually look like today, and what might we want to adjust in 2026?
We are here to help you move from a once-a-year filing mindset to a year-round collaborative approach. Thank you for joining us, and please reach out if you would like to explore how these ideas might apply to your own situation.
Thank you, everyone, for being here. We appreciate your time and look forward to continuing the conversation.